At the start of the year, investor consensus, as implied by the futures market, was for central banks of both the UK and US to cut policy rates around 6 times in the calendar year 2024. However, these expectations have changed notably since January, and at the time of record, in the final week of April, the expectation is now for just 1 or potentially 2 cuts before the end of the year. Global economic data has generally surprised to the upside so far in the first third of the year, and whilst inflation has trended downwards, signs of stickiness in price rises in some areas has highlighted how getting fully back to those target levels may prove more challenging in the near term. Despite these changing expectations on interest rates, the broad equity market has continued to move higher, albeit driven by a relatively narrow group of technology-enabled businesses. And whilst there is much to be optimistic about, not least with regards to the impact of innovation on medium to long-term economic productivity, the notable change in the macro environment clearly has the potential to widen cracks in some of the more fragile parts of the economy. And in today's episode, we'll discuss some of the methods of adding ballast and dry powder within portfolios given this backdrop. Hello and welcome to the Investor Insights podcast, hosted by Killik Co. My name is Gordon Smith, and in each episode, I'll be interviewing portfolio managers from across the investment industry to gain from their expertise in the specialist areas in which they invest, and to question them on the topical issues of today. Killik Co is an independently owned wealth manager which opened its first office in 1989 and provides services to help families save, plan and invest. And you can find more details of the unique ways in which we do that on our website, killik.com. In today's episode, we speak to Sebastian Lyon, the co-founder and chief investment officer of Troy Asset Management. Sebastian is responsible for Troy's multi-asset strategy. He's the senior fund manager for the open-ended Trojan funds and the investment manager of the London-listed Personal Assets Trust, ticker PNL. Sebastian is hugely experienced and began his career in 1989 at Singer & Friedlander, before joining Stanhope Investment Management, the management company of the GEC Pension Fund, in 1995, where he jointly managed the $2 billion equity portfolio and the fund's asset allocation. In the year 2000, he established Troy, and the company's successful flagship multi-asset strategy now runs over £8 billion across the various fund structures. The open and closed-ended funds have an almost identical investment approach. They are long-only portfolios, meaning the team do not use more complex instruments or hedging strategies outside of the management of currency risk. The funds have the ability to invest globally across traditional asset classes, meaning equities, fixed interest securities, cash or cash equivalents, and gold or gold-related securities. The primary aim of this strategy is to first preserve capital and for growth in real terms after inflation. And what we think will become clear in this discussion is that asset allocation is at the core of this strategy, and decisions on allocations are based on various factors, including the analysis of economic conditions, interest rates, inflation, and relative valuations. Sebastian, thanks so much for joining us. How are you doing this morning?
Very good, thanks, Gordon. It's lovely to be on the show.
So the first question we ask, Sebastian, is a kind of a standard opener. We ask a question that tries to get a bit of an insight into you, what you're working on at the moment, or your kind of typical working week. So I wondered if is there kind of an interesting book or article that you're reading, or just even an anecdote from a recent research trip or meeting that you've had? Anything you can share?
Well, the really fascinating thing about investing is it's never dull. There is so much going on. I'm busy, internal meetings, external meetings, seeing companies. And one of the things I've been talking about when seeing companies, which I never thought I would get into a discussion about this, but is actually, talking to senior management of FTSE 100 companies about being domiciled in the UK. And, it's clearly not untempting for them to be looking elsewhere for a variety of reasons, partly because the UK has languished until very recently. So that's been one sort of hot topic of the moment, which, as I say, I'd never thought I'd really be discussing. And I suspect that will be resolved, but nevertheless, it's definitely a concern for us as investors who are based in London, who want to invest in good companies in the UK. So that's one issue. I mean, I do spend quite a lot of time reading, try and spend as much time as possible reading, both internal research. We've got a great team of analysts here who write in-depth research on the companies that we like. But also, I've been reading The Psychology of Money by Morgan Housel and a book on Charlie Munger since he died. Read about when he was alive as well. But I think just the fact that he died sort of made me sort of go back and dust off Charlie Munger, The Complete Investor, which just oozes common sense. And as investors, I think it just he really keeps you on track. He stops you from making stupid mistakes. He just really keeps you rational, stops you being greedy, stops you being fearful. You know, there's the two evils for an investor are being overly greedy or borrowing too much. You know, making those foolish errors, short-term errors, and being too fearful when things are difficult, like in most recently during the pandemic. So the lessons that Charlie Munger teaches investors are timeless, really, and you just want to sort of go back to it and revisit it and remind yourself of how much he can serve you in terms of being a rational investor, basically.
Yeah, there's lots of very important lessons I think we can all learn from studying Charlie Munger. You're actually not the first person in the series to recommend something based on his life work since he passed. So that kind of says it all, really, in terms of his influence on the investment community. And Sebastian, given what we're talking about here is a kind of multi-asset strategy, investing across a range of different areas, I thought what we do with this discussion is run through the kind of primary buckets which make up the portfolio, and I thought we might start with the equity allocation, because it's often the most important, the bigger driver of returns. However, the equity allocation within the portfolio currently is sitting towards the bottom end of the asset allocation range that we've kind of typically seen over the last 15 years. I wondered if you could kind of run us through the primary reasons driving that current weighting at the minute.
It is the most important part of the portfolio, so you're right to start with it. I mean, it is. I've been running this mandate now for 23 years, coming up next month. And we always say that it's stocks, quality stocks, that really drive the portfolio over the long term. So about 65, but roughly 2/3 of the return of the fund, which is sort of just under 7% per annum since we launched back in 2001, have come from the equities. So, and that will be the case in the future. At the moment, less so. And the reason for that is just markets have had a very, very good run. Valuations, long-term valuations are high, particularly in the US market, which we like as a market because there are so many fantastic companies there. And you just have to go to the States to feel that sort of energy and that value creation, which has been there, but over the very long term. But we just are concerned that the US is, it's up to the sort of valuations that we saw at the end of 2021, which marked a peak for the market. And we've seen we saw a fall off in 2022 as yields rose. Our concern at the moment is yields are actually probably too low, and we could see a move up in yields again, as we see that interest rates aren't necessarily coming down as expected. The natural rate for the sort of 10-year US bond, which is probably about 4.5, 4.6 at the moment, we think could go up, back up to its old highs and maybe further, because I think one of the things that surprised people is how strong the US and how resilient the US economy has been post-COVID. And so that's the sort of threat. And that's a threat to valuations. And rather like in 2021, the threat to the market wasn't necessarily a downturn in earnings, it was where the valuations were. And people had got very, very excited post-COVID. There was a lot of cash around, valuations went up a lot. We're in a similar place now. The valuations are similar, not exactly the same, but they're similar to where we were at the end of 2021. And I think it's just better to err on the side of caution rather than err on the side of feeling very aggressive and feeling as we're paid to take risk at the moment. That's the way that I run this portfolio. Is if we're paid to take risk, increase equity exposure, I will do so. And we've had equity exposure as high as in the 70s, as low as in the 20s. And if I feel we're not really paid to take risk, just to ease back, just to take less risk, to sort of titrate the risk, as it were, and to take less risk because we're not necessarily paid to take that risk. And it comes back. Actually, I was just reading the Housel book, Psychology of Money, but um, effectively, a lot of people focus on the now. If you look at investment advice, it's all about today. What are the investment opportunities today? And actually, as investors, what we really need to think about is tomorrow. And and tomorrow might look better than today. It might look less good. But the thing that we've got to think about is where are we from the point of view of prospective returns? Prospective returns back in 2009, back in 2020, actually during COVID, because markets had fallen, prospective returns were much better. Today, as we're looking at highs, UK and US, prospective returns are lower. So you just need to get a little bit less enthusiastic rather than more enthusiastic.
Yeah, that's helpful. And you touched on the kind of the focus on the kind of very high quality names
Mm,
within the
mm.
universe. I wondered if you could kind of maybe give us a few examples of just what is meeting your criteria for getting in that equity bucket at the minute, where you are seeing kind of reasonable valuations. Are you able to give a couple of examples
Yeah,
there?
well, certainly. I mean, one example that I can give you that we've added to in the last year and continue to add to this year is Heineken. And staples have sold off. Staples were very popular during the pandemic for very obvious reasons. They were defensive. They continued to grind out good returns in what was a very difficult economic environment. And then following the recovery, they've really sort of given up a bit of that steam and valuations have come down. Heineken is a really interesting one in a way because it had a difficult COVID, unlike many of the staples. It had a difficult COVID because obviously people weren't going to the pub or restaurants or whatever. So the on-trade was dead. What's what they call the on-trade, which is out and about. And then and the off-trade was okay, i.e., people were drinking at home. But when the recovery came through and reopening really started in 2021 and through to 2022, they had an issue which was higher inflation and inflationary costs, particularly for travel, particularly for moving the products around, and costs of bottling were very sharply higher. And so actually the profits didn't come through in the way that the market was expecting. So you had a sort of a second lurch down. So as a result of that, the valuations came clattering down to a sort of mid-teens multiple, about 15 times earnings. That's very low for a company that's been around for 150 years and effectively makes one product, which it's brand leader worldwide, basically, and it's also the largest non-alcoholic beer worldwide as well. So we think it's a well-run business. It's family owned and controlled to some extent, which we like because it means we're aligned with that family. They're not going to sort of go off and gear up the balance sheet very aggressively or go and make outrageous acquisitions. They're thinking about long-term growth, they're not thinking about the short term. So that's one where actually we've been happy to buy into. One of the things that we do have this quality threshold because the way that we run this mandate, we do want to own equities where we feel confident in the long-term prospects of the business that aren't highly cyclical, that aren't going to get pushed around by the economic cycle. But we also, and this is sort of my experience as an investor over the long term, is we want to own or buy into companies that are pretty friendless, that for whatever reason, the sell side and the buy side probably think this is a bit boring. It hasn't really gone anywhere for a while. I mean, shares haven't really moved for about 7 or 8 years. So it's clearly not loved, unlike Nvidia. So that what we try to do is go for those businesses which are consistent, which are growing, where the prospects are sound, but perhaps where market's attention isn't really on that particular area, and that can change. And you don't know what the catalyst for that to change is. It could be a weaker economic environment. It could be a return for good strength in that particular business. They've got very strong businesses in Brazil and Vietnam, which are not necessarily, Vietnam hasn't been performing very well lately. That turns around, then you could see a situation where people get more interested and re-rate the stocks. So we think the downside is relatively minimal. There's never no downside, but the downside is not, it's not 75, 90%, which it can be in some very cyclical businesses. And if there is downside, we've got the confidence to actually buy more rather than think, oh my goodness, we've got this one wrong. So that's how we think about bottom up stock picking for the fund. And it's one of those things, it could be dull for a bit of time. And we don't mind that. We don't look for instant gratification. We look back to some of the things that we bought in the past. I mean, we bought a long time ago now, but we bought into Microsoft in 2010. No one was interested in Microsoft back in 2010. You know, it was on sort of 10 times earnings. It's on a double-digit free cash flow yield. Everybody thought it was a busted flush. And actually didn't do very much for about 3 or 4 years. It traded sideways, and we waited patiently. And obviously, it's probably been one of our best investments, not quite our best investment in the fund, but certainly one of the best investments in terms of driving returns within the fund over the last decade or so. So it's a question of biding your time and having that patience and looking for those opportunities, and they're not very common.
Yeah, thank you for that. That's useful, kind of framing that equity allocation. In answering one of the first questions, you kind of gave a sneak peek at your view on rates and inflation.
Yeah.
I wonder if we can move on to
Sure.
index-linked bonds. That is the kind of largest component of the portfolio. Could you explain, because it's often perhaps one of the areas which is most misunderstood, perhaps the kind of the importance of that in protecting capital, given your outlook at the minute.
Yeah. Well, index-linked bonds are occasionally a little bit misunderstood because they are a hybrid, really. They are, on the one hand, they're a fixed income, so they're a bond. But on the other hand, they do have those links to inflation. So the coupon rises with inflation and the capital rises with inflation. So for that reason, they are slightly misunderstood, I think, sometimes. But my top-down view, for quite some time, really going back to the pandemic, really going back to 2020, is that we were living in a world of zero interest rates, of very low economic growth, and actually of globalization. But that has been fading since the financial crisis. But nevertheless, that was the sort of backdrop to the world that we were in prior to the pandemic. And one of the things that I was pretty sure about was that once the pandemic, or once a downturn came, and it happened to be the pandemic, it could have been a recession, economic policy was likely to change. Prior to the pandemic, economic policy was all about monetary policy. Whereas when the downturn came, there was likely to be a change towards fiscal and monetary stimulus together. And that was going to be a very material change, because effectively what happened after the financial crisis is we had huge monetary stimulus, QE, zero interest rates. That found its way into markets. But what we didn't have is the money finding its way into the economy. Once we had COVID, that was the excuse, the catalyst for governments and central banks. Actually, central banks have been saying, we've done everything we can do here. We can't do any more. You know, the next downturn, it's over to you, to politicians. You know, it's over to you to spend. And so there was likely to be this fiscal stimulus, and we were likely to go into a new era, probably of rising interest rates and stickier inflation, because once you have fiscal stimulus, once governments get hold of that spending purse, they don't let go of it very readily. And that money is going to the economy. We saw it with furlough schemes. We saw it with effectively checks written to individuals. That led to the money actually going into the wider economy. We saw it in consumer goods during COVID, and then ultimately in services once we reopened. But I think that's a very, very material change. And I think that we've gone into a world of, having been in a world of falling yields, probably for the last 40 years, go to a world of rising yields. And we've seen actually the US 10-year yield break out of its long-term downtrend, which I think is very material for investors, material for equity investors as well as fixed income investors. But coming back to index linked, we think that we're now going into a world where inflation is likely to be stickier. I know that inflation's come down over the last year. A lot of that's to do with annualization effect of effectively one number being compared with a high number being compared with another number. But that last mile, that last 1-2% is actually struggling, particularly in the US. They're struggling, as we've seen in the last 3 months in terms of the CPI numbers in the US. They're struggling to get to inflation down to the levels which, frankly, were the roof. So before the pandemic, central banks were struggling to get inflation to 2%. They were struggling to make their target from the downside. Now they're struggling to make their target from the upside. So we think that inflation is likely to remain stickier for all the reasons that are well known. Firstly, globalization is in reverse. Secondly, rising geopolitics, which we're seeing, and frankly, the war with Ukraine, wars with Gaza, they don't help because supply chains get interrupted. Labor costs are actually higher. You ask a restaurateur or a hotelier, how are they coping? How are they doing getting labor? It's really tough getting labor, and it's good to some extent. People are being paid more, but it's harder to get labor, which has not been a problem for many, many years. Fiscal stimulus I mentioned, and then also the transition to a low carbon economy, which is also likely to have a cost. And the downside of reversal of globalization is onshoring as well. So which obviously keeps things internally within the economy rather than global trade. So all of these factors, all mounted together, probably mean that we're going into a world of stickier, higher inflation. And so index links, which now yield 1% to 2% positive, look pretty attractive to us. They're not going to make you an absolute fortune, but from my point of view of looking after people's capital, and in particular preserving wealth, 1% real, 2% real yields look a good start to me. If inflation is like to be stickier, let's say it's 3 to 4% rather than 1%, you're looking at a return, if you hold them to redemption, of mid, maybe even high single digits. So that's a good start. The other thing is within the and just to get a little bit technical here, but within the index linked world, there are things called break-evens, which is effectively the underlying inflation rate, the implied inflation rate between what fixed income is implying and what the index linked are implying. And break-even rates are surprisingly low still, despite all of the inflation that we've had in the last 2 to 3 years. Inflation expectations within markets are 2 to 2.5%. They're not saying inflation is going to be 3.5 or 4. So, and that's an opportunity, certainly from the point of view of being in fixed income rather than being in index linked. And that's why we would favor index linked, because we think that actually there's the possibility that those break-evens start to rise, which will mean the returns certainly relative to bonds. And I think that coming back to my comments about where yields are going and the new regime effectively we're in, where we're not in lower for longer and where yields for fixed income are likely to be higher, and you want to be very careful about your duration, i.e. how long the bonds that you hold are, this is not a world for 60-40 investors. And that's why we're not a 60-40 fund. We've always been a asset allocation. We're a multi-asset fund. We pick the right assets at the right time. We have been in fixed income, long-dated fixed income in the past and done very well out of it during the early noughties. But today we don't have any long-dated fixed income, and our fixed income allocation is really almost entirely in index linked. So that's why we're positioned in the way that we are.
Yeah, that's really helpful, and we'll maybe add a chart showing those kind of break-even inflation numbers and how anchored they've been, and what's happened to real yields in our research note, so listeners can take a look at that. If we move on to the kind of the next bucket being gold, and the strength in the gold price has taken quite a few people by surprise, really, year to date. I'm talking, particularly when. Usually you've got that kind of inverse relationship with real yields, which have kind of edged higher or kind of the same pretty high. And what's your kind of take on the drivers for the gold price? That's still an allocation within the fund as
It
well.
is. We actually did reduce it very slightly in in the last month for the mandate. Obviously, because it had such a good run, just from a risk reduction point of view. But to set the scene, gold has been an essential uh, portfolio insurance for us. It's been really helpful during the financial crisis. It was really helpful during the pandemic. It was helpful in 2022 during the invasion of Ukraine. And obviously, it's been helpful more recently in the last couple of months where we've seen it break out. Um, I think that there are a number of angles as to why gold has done what it's done, and I think that I think you're right, Gordon. There has been a misconception in terms of expectations for gold's returns. I think the misconception has been about um, correlations between real yields, and also there were many charts doing the rounds of negative yielding bonds, and the amount of negative yielding bonds, which you'll recall, and particularly in Europe, a lot of European investors suffered from not having to invest in negative yielding bonds, but there were a lot of negative yielding bonds to the tune of, and in Japan as well, to the tune of, I think, $1.18 trillion. There are now almost no um, negative yielding bonds because interest rates have risen. Um, so that support went, or supposed support went, and the gold price ignored it. So perhaps, and the same with real yields. And I suspect clearly something else is going on here. And the answer is that actually, if you look back in the past, a rising yield environment is not necessarily bad for gold. In the late 1970s, the gold price went from $100 to $800 in a period where interest rates were rising quite quickly and quite sharply. Um, but that was due to inflation being high, and so people wanting that inflation protection. So maybe that's a reason. People are worried about, basically, they're worried about inflation and they're worried about debasement of currencies. The other thing is, I always encourage our investors to look at gold in other currencies, not just in the US dollar. Everybody focuses on the US dollar price, and to some extent, they're right to focus on the US dollar price. But we're in the UK. Look at gold in sterling. Look at gold in euros. Look at gold in Japanese yen. Actually, with the exception of the US dollar, which has been very strong, gold had been in a bull market for quite some time. It had been making new highs. It made new highs in sterling in 2023. It made new highs in euros in 2022. So this pressure and the demand had been building up. But why is that? And I think the one of the major reasons, and this is a long-term reason, but I think one of the major reasons has been this, with the invasion of Ukraine, the confiscation of Russian reserves has meant that countries that are not aligned with the US are looking to diversify out of the dollar, de-dollarization as it's called. And so central banks, since that decision in February, March of 2022, so 2 years ago, central banks outside of the US and the UK and others, the global south, particularly China, but also other countries like Singapore and Poland and Turkey, have been adding to their gold reserves. So they have been supporting the price. And then finally, there are Chinese private individuals who, I think, disappointed by the very poor performance of Chinese equities and Chinese property, and in the knowledge that they're probably looking at a devaluation of their currency, are looking for ways to preserve wealth. And that's been the sort of final push up, because it's been, I think, primarily driven by those private investors in China. Now, how sticky or speculative those investors are, we've yet to see. But the plus is that private investors and central banks tend to buy and hold. They don't tend to trade. And there's been the focus on the Western investors, and Western investors have been selling out and selling out over the last. You look at the ETFs, and they've been selling down over the last 3 years since 2020. So they're not. It's not about Western investors supporting the price of gold. It's about these influence have come elsewhere, which is why actually focusing on US real yields, for example, has not been helpful in terms of what's happened with gold. But I think that one of the reasons for its surprise strength has been to do with the recognition that inflation's stickier, commodities are stronger again, which means there's the potential threat of a second round of inflation, second wind of inflation. You only have to look at the price of um, coffee, cocoa. Cocoa has gone absolutely ballistic in the last 6-9 months. So it's not just gold. But I think that's the reason why gold has performed in the way that it has performed. And we'll see how sustained it is. But certainly from the portfolio's perspective, it's doing its job in terms of the fact that it is producing positive returns for us, in what's still a challenging investment environment,
Yeah,
and producing sort of essential diversification as well.
yeah, absolutely. I know. Thank you for that. Lots of very powerful factors at play with the gold price, with,
Yeah.
with central banks in particular, I think. Sebastian, my last question is another standard question. So we have asked this to all people that have come on the interviews. It asks about the kind of highest conviction area at the moment, and given that we've kind of laid out that kind of outlook at the minute, it might be a slightly different way that you might have to answer this question. But I wondered if there was a particular area that you do have a high conviction in, or whether you could kind of run us through how this dynamic asset allocation will work if the environment changes and
Yeah.
equities could play a
Yeah.
bigger part of things, for example.
Yeah. So there's sort of slightly two sides to that question. I mean, it's always difficult to know what's the favorite part of your portfolio. I mean, it comes back to my question about what are you excited about now, and
Yeah.
it's not about now so much. It's about positioning yourself for the future. So I think that, and it's always difficult, when somebody says to you, what's your favorite stock? What do you think's the most likely to go up? Firstly, it's almost certainly not going to be that one.
Yeah.
Secondly, it's almost like being asked what your favorite child is. You want to be a bit diplomatic. But I do think that, I mean, clearly the last 12 months, investors have been very excited about tech and very excited in particular about the prospects for AI. And and uh, there's lots of evidence on both sides of the argument as to what AI is going to do for the economy, what AI is going to do in terms of generate, higher returns, higher efficiency, um, and probably a little. And I mean, some people are terribly excited about it and talking about it as the sort of the next internet, the next sort of railroads, that sort of huge effect and change on the economy. I think the first thing is to remain open-minded about it. I think the second thing is to keep your feet on the ground. I think there's been a lot of, I mean, obviously Nvidia's gone parabolic, but that's always concerning. When people say the word bubble, we sort of start getting nervous and moving in the opposite direction. Um, but I think that there have been some things that have been left behind, and I think some of those staples, which have been very dull because people have sort of been bored of them, the Heinekens and the Unilevers of this world. I think that that's somewhere where over the next 2 years, 3 years, could actually do you okay. Could be fine. They're very friendless. So I think that they have been rather left behind. They're not bad businesses at all. And the prospective returns for these sorts of levels, now mid-teens multiples, when you've got a lot of stocks that have, in the 20s and frankly now 30s multiples, you've seen huge re-ratings in the last year in a number of parts of the market. And re-ratings are great when you hold the stocks. They're not so great when, like we saw in 2022, when you see very sharp de-ratings. And so I think that part of the market is ripe for reappraisal. It's something that we're leaning into, not aggressively, but we just feel that on a medium term, those opportunities are there. The downside risk is relatively low. So those are the parts of the market which we think, parts of the stock market, which we think are sort of more interesting than the more very exciting parts of the market. We do hold Microsoft still, less than we did. We've been de-risking it just because we think the prospective returns, however good, if you think the returns are going to be 15% per annum from a starting PE of about 33, if you think the 5 years time the PE might be 25, which would still be quite generous, you're looking at a high single digit, low double digit return. So the risk return in some of these stocks isn't just quite as good as it feels looking back rather than looking forward.
Yeah, the compounding of a dull and boring stock, which is currently unloved, it could be
Yeah,
very powerful for a portfolio. Absolutely.
absolutely.
Mm.
Yeah.
Sebastian, thanks so much for taking the time. Always interesting to talk to you, and appreciate that.
Gordon, it's a pleasure. Thanks very much.
Thank you for listening to the Investor Insights podcast. You can contact info@killik.com, referencing the podcast for more information on any of the topics discussed, or for further details on the services offered by Killik Co. This podcast is not personal advice. The content is intended for educational purposes only and is not investment research or a recommendation to buy or sell any financial instrument or product, or to adopt any investment strategy. The value of your investments can rise as well as fall, and you could get back less than you invested. Past performance is not a guide to future performance. The investments referred to in this podcast may not be suitable for all investors, and you should seek advice from a qualified investment advisor. Killik Co is authorised and regulated by the Financial Conduct Authority, the FCA.